Good morning, everyone. You're welcome to today's edition of the Vetiva Breakfast Meeting, brought to you by Vetiva Capital in partnership with Frontier Africa Reports. In today's session, we'll be getting the usual rundown of the fixed income and equities markets from our traders. We'll also have joining us today our partners at CJF Boss, and they'll be giving us updates on the BRVM. Then we'll round up with headlines from across Africa by our media partners at Frontier Africa Reports. Before we go on, I'd like to remind everyone that the meeting is being recorded and it may be shared with third parties. It is also being streamed live on our Vetiva online Facebook page if you'd prefer to view or join from that platform. And the session is set to last for 30 minutes, inclusive of Q&A. During the course of this session, if you have any questions, you can send them in using the chat function available on Zoom. And if you're joining us from Facebook, you can make use of the comment section. However, we'll be having a Q&A segment, and if you'd prefer to speak, you may use the raise hand function and you'll be called upon to speak. We'll now be starting off with Simbiat from the Global Equities Desk, and she'll be taking us through some equities markets. Good morning, Simbiat.
Good morning, Victoria, and good morning to everyone. So I'll be doing a quick run through on the performance of some of the equities market in West Africa, and I'll be starting in Ghana. The composite index in Ghana closed marginally up by 7 basis points as consumer goods sectors, specifically in Nineveh, Ghana, continues to lift the index. The stock gained 9.93% yesterday, and this will be the second consecutive gain we have seen for the stock. With the absence of little or no positive triggers in the markets, we have seen quite trading sessions recently and activity levels declining further. So going into today, we expect market to continue to trade in similar pattern, with the possibility of increased demand in Enterprise Group, MTN Ghana, ETI, which would boost activity level. Finally, in the Nigerian equities market, the market started the week in the red zone as all share index shed a marginal 4 basis points. This was due to price depreciation, specifically in the banking space, as we saw the banking index close 65 basis points down. The sectoral performance was mixed yesterday, with consumer goods closing marginally up by just 2 basis points and insurance by 4 basis points. But the oil and gas index had a decent gain. It closed up 16 basis points on the back of price appreciation in MRS. The stock gained 9.92% yesterday and also set a new year high at 13.85 kobo. And with year-to-date return now at 0.73%. In absence of any large cross trade yesterday, activity levels dipped significantly. Trade volume fell by 25.17%, while turnover did by 49.16%. So going into today, we expect investors to trade cautiously and market closing flat, barring any major sell-offs in any of the large cap names. Thank you, and that'll be all from my end.
Thank you very much, Simbiat. We'll now be moving to Omorige, and he'll be taking us through fixed income and currencies. Good morning, Omorige.
Good morning, Victoria. Good morning, everybody. System liquidity improved slightly yesterday to open at 14.1 billion positive, coming from the 11.6 billion positive that was recorded on Friday. Despite the slight improvements in system liquidity yesterday, interbank rate tightened by over 20 basis points, as OBB and overnight rate closed at 17% and 17.5% respectively. For expectations today, we believe that money market will trade at lower levels on the back of OMO repayment of about 156 billion that is coming into the system today. The parallel market remained stable yesterday to trade out 515 naira to $1, while the earning window opened at 411.42 naira to a dollar. The highest rate that was recorded on Monday was 415 naira to a dollar, while the closing rate was 411.67 naira to a dollar. After consecutive days of losses, Brent and WTI both gained 0.3% to open today at $69.64 and $67.43 per barrel respectively. The rebound was spurred by expectations that top oil producers will not boost supply soon, despite the fears of weaker global oil demand amid surging COVID-19 cases. The T-bills market opened this week with main sentiment as we observe sell-off on the short-dated maturities, while continued buy-side interest we are seeing on the long-dated maturities, especially on the newly issued one-year paper. That's the August 11, 2022 maturity, while trades were largely consummated on the 27 January 2022 paper. Overall, average benchmark rate rose by 22 basis points to close at 4.74% at the end of yesterday's trading session. The OMO market opened this week on a muted note as average benchmark rate remained unchanged at 7.5% from the previous trading session, while trades were majorly consummated on the short end of the benchmark curve, particularly on the 31st August 2021 maturity. The bonds market opened this week on a quiet note as market players remained on the sidelines ahead of the monthly bond auction that is holding tomorrow. We saw bids improve because of the paucity of offers in the market. Consequently, offers on the most actively traded maturities yesterday, the 2035, 2036, and the 2050 shared few basis points over around 12.5%, 12.55%, and 12.85% respectively. Trades were majorly consummated along the short and long-dated maturities, especially on the 2029 and the 2050 papers, as average benchmark rate remained unchanged at 11.96%. The Eurobond market opened this week on a very active note as sell-offs were seen on the sovereigns. As a result of the sell-offs witnessed across the curve, offers on the 2049 maturity improved day on day to settle around 8%. The corporate space witnessed few sell-side interest on the Access Bank 2021 and the Fidelity Bank 2022 Eurobond. Also, in another news, Nigeria Bank of Industry plans to issue about $888 million global bond sale to provide lending facilities to the local companies hampered by the COVID-19 pandemic. For our expectations today, we expect the current sentiment in the bonds market to persist as players continue to trade cautiously in anticipation of the bond auction slated for tomorrow. For the T-bills market, we expect it to trade actively today with a bullish bias as investors try to reinvest the OMO repayment of about 156 billion that's coming into the system today. That'll be all for fixed income. Thank you.
Thank you very much, Omorige. Next up is Faith from Frontier Africa Report, and she'll be giving us some headlines from across Africa. Good morning, Faith.
Very good morning to everyone. I'll be starting this morning with Forex reserves fall to 7-week low of $9.3 billion, while the FMO pumps $550 million for SMEs. Limuruti is having the half-year results for the year 2021, showing an 8% decline in revenue to
Hi, Faith. Your network seems to be delayed.
In Ethiopia, the central bank is ordering, and in West. Hello?
Yes, we can hear you, but it's skipping a bit. Hello, Faith, are you still with us?
Yes, I'm with you. I'm asking if you can hear me clearly now.
Yes, yes, we can hear you clearly now.
Okay, so do I go on with West Africa and Nigeria?
Yes, yes, you can.
Thank you. So in West Africa and Nigeria, President Buhari has signed Petroleum Industry Bill into act. And in Ghana, the budget's defense is set to the budget's deficit is set to ease to 7.9% of the gross domestic product of that country in the year 2022. In Mali, Office du Niger has posted turnover of 7.6 billion CFA in the year 2020. In Niger, the largest bond issue of 150 billion CFA is being put out on the WAEMU. In South Africa, the Time Bank is securing digital banking license in Philippines, while Implants sees the financial year of 2021 earning surging to 35.8 rands, between 35.8 rands and 36.8 rands. In Zimbabwe, the first capital foreign companies loan is soaring to $18.7 million in the half year of 2021. And lastly, in North Africa, Egypt is offering 2.8 billion Egyptian pounds to finance SMEs in 6 months. Also in Egypt, the country is denying new 100-pound coins into market. Colorado's second quarter report is showing a turnover rising 64.1% to 154.3 million dirhams. And in Tunisia, to wrap it up, the GDP is growing 16.2% year on year as at the second quarter of 2021, while the admin capital for urban development is planning to list on Egyptian exchange very soon. All of that from North Africa, and with that, we'll wrap it up from here. Thank you so much for listening to us.
Thank you very much, Faith. We have now come to the Q&A segment. If you have any questions, you can send them in using the chat function on Zoom. And if you're joining us from Facebook, you can make use of the comment section. Also, if you prefer to speak, you can make use of the raise hand function and you'll be called upon to speak. It looks like we already have a question. Okay, it says, good morning. This is to the oil and gas analyst. With the signage of this version of the Petroleum Industry Bill, what are expectations for the players in the downstream sector, and does it mean subsidy has been finally removed? I'll direct this question to our oil and gas analyst, Luke Ofojebe.
Good morning, Victoria, and good morning, everyone. With respect to the question, yes, yesterday, the President finally signed the PIB into law. However, we do not expect that to translate to the removal of subsidy in the downstream sector. And that's because at the moment, the government is still expressing socialist views towards subsidy expense in the country. I mean, when you look at where inflation is at the moment, around 20%, full inflation already above 20%. And I see the expectation that, power tariffs could be reviewed any moment from now, maybe by the end of the third quarter or by the end of the fourth quarter. And it's likely that, power tariffs will be raised higher. So that should also translate to further cost pressures across board. So because of these concerns, we do not expect the government to remove subsidy completely. However, what we expect to see is that we might see an increase in the regulated pump price of PMS. Probably the government might decide to raise it to around 180, 190 naira per liter, just to reduce subsidy expense, just to reduce the daily subsidy expense that it currently incurs. I think that will be the answer to the question. Thank you.
Thank you very much, Luke. We can take in more questions. Okay, we have someone that has hands raised. Aurelia, you can speak now.
Okay, good morning, everyone. With what Luke just described to us, so it means inflation will increase vis-a-vis what we are seeing in the market now, that rates at least their rates have reduced, rather tanking. So what's the implication for the market? Because if inflation is increasing, like we all know, then investors will be yearning for more in terms of yield or rates, such as their real returns, at least should be something, if not totally positive, at least it should be a bit on the lower side in terms of being negative. So what is the implication, especially for the foreign guys that have some of these things cut out at the beginning of the year in terms of what they are looking at in terms of the year-end yield on the assets?
Okay, thank you very much, Aroye. I'll now direct this question to Dapo to take.
Thank you very much. So with I wasn't quite sure, Mr. Aroye, if you were speaking to fixed income market yields or equities or, downstream players. I don't know if you could clarify so I can speak clearly to the question.
Okay, so for the fixed income market, that's where I was speaking to.
Okay, so again, it's removal of subsidy, as Luke has clarified, for example, is not something that we're expecting or looking at in the near term. And pretty much if we say the impact of that on the yields in the market would generally be that subsidy increases cost of running the government. And so the government is still under pressure to fund pretty much for whatever shortfalls they need to cover. So we don't see so much if there's any translatory impact of that just into the market just yet. We'll continue to watch, obviously, and try to provide any clarity or guidance as the months go by. But generally, for market outlook with respect to rates, we believe in the near term that the rates trajectory is still downward, simply because, again, the government is expecting some external funding in the next couple of days and in the next couple of months, or not up to months, if they tap the market early. And this should provide some much needed support. The stance of the central bank recently has also been not so aggressive with respect to CRR debits. In the last couple of weeks, we've not also seen OMO auctions in the last, I think for about a month now, we've not had any OMO auction. And these postures are generally conflicting, whilst we note that at the last NTB auction, yields dropped again, but the government significantly overborrowed. And this was because it appeared that was cheap funding for them. The market itself is anticipating that rates will dip, and we believe in the near term, looking at funding expectations from external sources from the government. And as the year continues to wind down as well, things will just follow that trajectory. So in Q4, we expect that early Q4 rates would most likely continue to tank. But towards the end of the year, depending on how low it goes, we might start to see traders and market players taking positions against the budget reset early 2022. And given that 2022 is a pre-election year, we expect that government funding requirements will also be very strong. And so people will just generally like to position against that. I hope that answers the question.
Thank you very much, Dapo. We have another question in the Q&A box, and it says, generally, is the petroleum industry bill a positive for the downstream listed companies?
Thank you once again, Victoria. So really, going by the content, going by the content in the bill, it should be a positive for all downstream players, because what it means is that we are going to see a deregulated market for PMS, and that should lead to improvements in margins, given that in a deregulated market, you expect prices to be reflective of market forces, basically. However, I don't think we are close to that reality anytime soon. That's because, I mean, like I said earlier, we are still going to be seeing, subsidy regime in the interim. I think, in my view, I think before we can see a deregulated market for PMS, then we might need to see, Dangote refinery coming on stream. That should help to, reduce, shipping costs that usually, impact the landing cost of PMS. And on that basis, we might then see a deregulated market for PMS. But until then, I think we might just continue to see, prices of PMS being regulated, basically. Although, like I mentioned earlier, we might see like an increase in the price cap just to reduce subsidy expense. Thank you.
Thank you very much, Luke. It seems we do not have any question, and that means that we have come to the end of today's session. On behalf of Vetiva Capital and our media partners at Frontier Africa Reports, we thank you for joining us today. We hope that you have a productive day ahead, and we urge everyone to continue to stay safe. Thank you and good morning.